today we're going to start off, we're going to talk about cost centers and profit centers. We're going to talk about segment margin and what that means, return on investment, which is a very important concept in accounting and business that we need to be familiar with. We're going to talk about turnover. We're going to talk about sunk costs, avoidable costs, and guess what? Fixed costs and variable costs. We're going to see how those are related. Then we're going to talk about relevant costs. So relevant costs are those costs that are meaningful to our decision. Remember, we said as managerial accountants, we need information to make decisions. So relevant costs are those costs that are going to impact our decision to go forward with a particular project or a particular initiative. Remember, we might have information about a wide range of costs, but there's only certain costs that we want to consider that are important to the project, and not just important, but costs that are going to impact our decision to either go forward with the project or to not go forward with the project. So if you're working on a particular project, very often projects have a go, no-go decision point. So what happens is you basically spend a little to learn a little and then decide whether or not you're going to move to the next stage. Now in some cases, when I say spend a little, it could be like $250,000 to do market research or to do product design, but at the end of that stage, then you have to decide whether or not to go forward. So we need to know what course to consider. So take, for example, market research. Market research, I would say, is a sunk cost. Why? Why would you think, if we're working on a project and we have to decide whether or not to continue the project, why would you consider market research a sunk cost? We can't get back the money, exactly. So if we spent $150,000 to do quantitative research, that money is gone. And whether we continue with the project or don't continue with the project, that money is still gone, right? It's not like we could get it back. So that would be a good example of a sunk cost. You know, at a personal level, as managers, as executives, we always fall into that trap in considering costs either sunk or not. And the trap is that it's hard to let go and say, well, you know, we spent $1 million on that piece of equipment. How can you tell me we shouldn't consider that in our decision to go forward or not go forward? And it's like Irina said, finally. A moment of truth. Like Irina said, that it's not going to change, right? We're not going to be able to get back that $1 million we spent on the equipment. That shouldn't impact our decision to go forward or not. But think about it. If you were the manager or executive, you're going to keep saying, wow, you know, we spent $1 million on equipment. What do you mean? How can we not consider that? You know, we should. We should say, you know, if we don't go forward, then we wasted $1 million. Well, yeah, it could be, but just think about how much more money you would waste if you didn't stop the project. Because when we do market research, for example, we need to know if we're making the right decision or not. And it could be very frustrating if you're a manager to be working on a project and then find out that the consumers are not interested in the concept that we could have spent months developing, but they feel that it's not relevant to their lifestyle. That's not something that's going to help them make their life easier. So you have to discontinue the project before you spend money on equipment. And it's better to spend that $150,000 on market research and stop than keep going and spend money on more research and product design and purchasing equipment. So that's why relevant course and some course are something that is important for us as managers and as accountants. Something that we need to internalize. So let's talk about the difference between a cost center and a profit center. What's the difference? Why do we even need to make that distinction in an organization? So for example, in a given organization, there's a variety of different departments. Let's say there's 10 departments. What does it mean to say one department is a profit center and another department is a cost center?
Which department brings in the money, which department spends the money.
Right, basically, right, everybody get what Damon said? He's saying that basically one department is generating revenue, one department brings money in, and the other department spends money. So a profit center is responsible for both revenue and expenses, but a cost center, they're not selling anything. They don't have any sales, right? They're not generating revenue. They're just incurring expenses. Like, what would be a good example? What do you think is a good example of a cost center in an organization?
Accounting.
There you go. Right? What do accountants do? Count. Right? That's what accountants do, is they count. They count the money. They don't generate the money. They're not generating revenue.
Aren't they finding ways to get more revenue, like cost of goods sold, how to maneuver more?
They could definitely have an impact on the profitability of the company. Absolutely, if we could identify cost reduction opportunities. So when accountants working in the manufacturing facility develop the standard cost for a product, what they do is they show what percentage of the cost comes from each component, as well as manufacturing overhead. So remember we looked at direct materials, direct labor, manufacturing overhead, and in some cases there could be component parts that maybe we buy from another organization that are already assembled. So the standard cost buildup is going to show that, and also show what percentage of the cost that represents. So generally, when you see that a certain cost represents a significant percentage of the product cost, which we said are what? Manufacturing costs, that are also referred to as inventoriable costs, then we're going to target those for a cost reduction. One component I could tell you across multiple industries that represents a significant percentage of the product cost is packaging. You really would be surprised that packaging represents a significant percentage of the product cost. So look at, for example, this bottle of water. What's in there? What's in that bottle? How much does that cost? $150? $150 for a bottle of water. Now, how much do you think the water costs? And how much do you think the plastic bottle costs? Plastic is very expensive. Cardboard is also very expensive. Like these cardboard boxes here, corrugated is a huge industry and very profitable for many companies. And cardboard is very expensive. Very often, it costs more for the box than it does the product. And I can tell you this from my experience, all right, looking at numbers at different companies and at their standard cost. It's like breathtaking that the box is $3 and the product is 50 cents. Like, wait a minute, it costs us 50 cents to make the product, and the box is $3, and something is wrong with this world, right, that we live in. Like, I mean, is this some kind of joke? Right? We're thinking, oh, we could make the product for 50 cents, and maybe we'll sell it for $3, and we'll be able to cover our fixed costs, our variable costs, our selling general and administrative expenses, pay our taxes to the government, and still be profitable and have money to pay dividends to our shareholders. But now we find out that what costs us 50 cents to make has got to go in a box that now costs $3. So now we're going to be selling the product for maybe $7.99 or maybe even $10. So a segment of a business responsible for both revenues and expenses would be referred to as a profit center. But as you both pointed out, an accounting department is a good example of a cost center. Even though, as Damon said, there could be an opportunity, accountants could identify cost reduction opportunities. The accounting department does not generate revenue, right? They don't generate sales. That would be a good example of a cost center. All right, let's talk about segment margin. How do we calculate segment margin? Say it again. I think I heard you say the right thing. Traceable.
Contribution margin minus traceable.
Right, so from the contribution margin, we're going to deduct the fixed expenses that we could trace back to the segment. And that was one of the questions on the quiz. It says segment margin is computed by deducting the traceable fixed expenses from contribution margin. And remember what we said early in the semester that was significant about costs that are traceable. That was the difference between direct and indirect. Remember we said that direct costs are those that we could trace back to a particular product easily. Importantly, it should be easy. Because there's some costs that we could trace back, but it's just ridiculous. I mean, we could spend hours and hours trying to figure out how much thread was used to make this suit. Well, yeah, I guess we could figure that out, but I mean, that's kind of ridiculous, right? I mean, that's such a small percentage of the product cost. We captured those costs as manufacturing overhead. Those costs that are not easily traceable, that we consider to be indirect costs. All right. Here there was a question about return on investment. Actually, there's a couple. The first one talks about how do we compute the return on investment. And the best answer here is multiplying its margin by its turnover. Right? That was one of the key learning objectives in chapter 10 is how do we compute the return on investment. So we multiply the margin by its turnover. The next question is a bit of critical thinking. It says, assuming that sales and net income remain the same, right? So sales and net income are going to remain the same. The company's return on investment will, and in this case, it's decrease with its turnover if its turnover decreases. So assuming that sales and net income remain the same, a company's return on investment will decrease if its turnover decreases. So we need to understand the efficiency and the effectiveness of our assets and our investments. We need to know if we've made the right decision. So we have to look at specific investments, not just the company as a whole, because what could happen, for example, is we might have one strategic business unit that could be very profitable, and another strategic unit that's unprofitable. Overall, the company might be profitable. We might have a net income of 15%, which is really best in class. Net income of 15% is exceptional. Very few companies actually achieve that, except very successful companies, for example, like Johnson & Johnson, has consistently achieved net income between 12 and 15% over like the last 25 years or so, which is really very impressive. Who could tell us what that means when we talk about net income? Because you might think 15%, that doesn't sound like a lot, does it? I mean, is that 50% would be better? Remember, net income is after we subtract cost of goods sold and after we subtract the selling, general, and administrative, right? That's what's left after we covered our expenses. So in some cases, in some industries, cost of goods sold could be 50% of sales, 60%, 70% even. In some cases, it could be that the selling, general, and administrative are 50%. But they can't both be 50%, right? Because we're definitely not making any money. Right? Then we definitely have an unprofitable situation. But it depends on the industry. That's why I mentioned that. In some industries, cost of goods sold could be 80%. In some cases, it could be 20%. It depends on the product. Questions about that? All right, let's look at this problem where we're going to calculate the margin for this division. The name of the company is Southeastern, a division of Ginger Enterprises, has the following financial data. And what we're going to do is calculate the margin for the division. This was from the quiz. So let me write the financial data on the board. Sales, $600,000. Net operating income, $75,000. Not too bad. Average operating assets is $300,000. Stockholders' equity is $240,000. And residual income is $39,000. So what we're going to do is we're going to calculate the margin of the company. Anybody want to take a guess? Anybody think you could just eyeball it? What do you think? What's the margin of the company? Nobody? Nothing jumping out at you? Okay, we'll do the calculation. All right. So the calculation to determine the margin for this division is net operating income divided by sales. So in this case, what we're going to do is we're going to divide $75,000 by $600,000. And then what does that turn out to be? basically 12.5%. Which is, based on what I just said, is that good or bad?
Good.
Right? That's actually very good. 12.5% for the company is, for this division, is actually very substantial. Most companies have net income that's about 5% of sales. That's about average. So this is actually quite impressive for this division. And that's for that year. All right, so what we're going to figure out now is the turnover. All right, so we calculated the margin for this division. Now we're going to look at the turnover. So to calculate the turnover for this division, we divide the sales by the average operating assets, which in this case we're told is $300,000. So we divide the sales, 600,000, by 300,000, and we've determined that the turnover is 2. What do you think? Is that good? What does that mean? What does that mean if the turnover is 2? Somebody? Anybody?
Means for every dollar in operating assets, we generate 2 of the sales.
Right, so that sales are twice as much as the average operating assets. So it gives us a sense as to the relationship between sales and our assets. So the higher the turnover is, the better the performance of the company. Because what that would mean is that these assets are generating a significant amount of sales. So if this was 3, that means $300,000 in assets would be generating $900,000 in sales. Now remember, we said that one of the things that has a stranglehold on manufacturing companies, for example, if you look at the automotive industry, if you look at Ford, Chrysler, General Motors, the stranglehold on these companies is the fact that they have huge fixed costs. So their problem is that this number down here is very large, and the number up here is getting smaller. That's the problem, is that their turnover is lower than would be desired, because they have huge physical assets. Right? They have billions of dollars tied up in physical assets, the manufacturing facility, for example. But it's not generating the sales that it used to. Now, 30 years ago, when they were the market share leader, before companies like Toyota showed up, things were going very well, because their sales were very high. But now a significant percentage of their sales have declined, but they still have those huge fixed assets. They still have tremendous fixed costs. And they've tried a variety of approaches to try and address this. It's not like they didn't do anything. That's why, for example, they've acquired other car companies. And the reason they did that is because if your manufacturing facility is operating at, let's say, 40%, I don't see how you could make any money. Really, it's going to be very hard for you to be profitable. You're operating at 40% of your plant capacity. So what they did is they acquired other companies because what they did was they want to put their manufacturing into their current facility so that they could achieve 80% manufacturing capacity or 90%. But keep in mind, 100% is not really desirable, because that means if you do have an increase in demand, you're not going to be able to respond. So if you get to 90% of capacity, then you need to start thinking about whether or not you're going to increase your manufacturing capability. So if you're at 100%, that could be actually a bad thing. I mean, you may want to stop advertising, because what if people actually saw your commercial and they came and wanted to buy your product? You won't be able to produce it. Now, in some cases, in some industries, it's actually very rare where you want to create some hype. Like, for example, in entertainment, it's very common, and people accept the fact that there's shortages. In other words, you go to the store, they don't have the DVD, or they don't have the CD. And people feel that, well, that makes it more desirable because there's scarcity, right? In economics, we talk about scarcity, that there's a limited supply. But in most cases, people are not going to go back to the store. It's not a high involvement purchase. So maybe a music CD or a DVD for a lot of people is a high involvement purchase, and they would bother to go back and check. Not the next week, maybe the next day they go back into Target or Walmart or Best Buy to see if the CD came in. But for most products, people are just not going to bother. And if you came out with a product and you were advertising and you don't have it, they went into the store, do you have this product? And they say no, all right, that's it, on to the next thing. They're not going to come back and keep checking. That's why when we advertise, what we have to do is wait until we have distribution before we start to advertise. So our product needs to be on the shelf at Walmart, Kmart, Target, Best Buy, Macy's, wherever, before we start to advertise. Because if we start to advertise and people go into those stores and the product isn't there, we wasted a lot of money. A lot of money. And that has happened. Companies sometimes do that, unfortunately. All right, so the next thing what we're going to do for this company is calculate the minimum required return. So in this case, to determine the minimum required return, we have to subtract from the net operating income, the residual income. So what is that going to be in this case? We're going to subtract from 75,000, we're going to subtract 39,000. And that's going to give us the minimum required return of $36,000. How is that helpful to us? Remember early in the semester we looked at target profit. Do you remember we talked about target profit? And we said, what if our goal was to have a profit of $50,000? And then we did an analysis to determine how many units we would have to sell, at what price, and with what level of margin. But that's what we're trying to do here as well, is to understand what is the minimum required return here, so that we could go through some what-if analysis. And in this case, it's $36,000 based on the information for this division.
So that's the minimum profit you're willing to receive?
It's an estimate.
Is that the minimum profit you're willing to receive in your sales?
Based on the information that we have, that would be the minimum. Based on this level of operating income, which this is going to be equivalent to actually 12%. So our actual is 12.5%, but the minimum required rate of return is 12%. This is actually 12%, and we could calculate that. So that would be, let's see, we could do that over here. Let's do that over here. 36,000 divided by 300,000 is 12%. So, like, this is margin. This is 12.5% is the $75,000. So 12.5% of the $600,000 in sales is our margin. That's the net operating income. But we could look at these two percentages to understand where we want to go as an organization, because what this tells us is we know that the minimum required return is $36,000, but we could calculate that as a percentage. So $36,000 is the 36. Right, is the minimum required return as a percentage of the average operating assets, which in this case they tell us is $300,000. So that tells us the minimum required rate of return is 12%. So if this was $200,000, if we had less money tied up in equipment, then the minimum rate of return would be much higher. But it depends on the company. It depends on how efficient the assets of the company are. And that's what we're trying to determine. That's why we need to go through this analysis. So what is the residual income? Right, we could calculate that. Here they tell us, but really the residual income is the net operating income minus the minimum required return. So net operating income minus the $36,000 is residual income. But remember, sometimes we have to plug the numbers, right? It could have been, we may not have known this. In this case, we do. It's this that we don't know. So the way to figure this out, remember when we went through these calculations before? This we don't know. This we know is 39,000. So that's the minimum required return, is the $36,000. But in this case, we're told
everything on that side is missing from the screen. From the screen, everything is missing.
This over here?
Yeah.
36,000? So in this case, they tell us the residual income is $39,000. But we could have looked at the minimum rate of return. So let me rewrite this so you can see this. Because the residual income, assuming we have the information, is easy to calculate. So residual income is the net operating income minus the minimum required So the net operating income minus the minimum required return is the residual income. So in this case, it's what, 75,000 minus the 36,000 gives us the 39,000. That's the residual income. So it's how much the net operating income is above the minimum required return. So in this case, the net operating income is 75,000, but the minimum required return is only 36,000. So the residual income, the 39,000, the amount above the minimum required return is what we just calculated. You follow? Questions? So what we're continually trying to do is determine the efficiency and effectiveness of the organization. And so we continue to look at a variety of different metrics and do a variety of different calculations to determine, is the company performing well?
Can we calculate minimum required return without, if we don't know our residual income?
So how would we do that?
Yeah, that's my question.
Right, so who can tell us? We need to know at least 2 of the 3 variables in order to calculate it. So if either you have to know either the net operating income and the residual income, or we're going to know the net operating income and the minimum required return, or some combination of them, in order to.
So I don't understand why we calculate residual income.
Well, in this case, no. But what I'm showing you is how we were able to get there, right? So that I want to show you the relationship between the residual income and net operating income. So the point is that, what is residual income? What is that? Why is that important? Well, because we need to understand, when we talk about margin of safety, we need to understand how much safety do we have? How much is the margin of safety? If our net operating income is 75,000, we need to know, is that good? Or is that satisfactory? Or is that unsatisfactory?